We want to always say thank you to our funding source, Workforce Solutions Rural Capital Area. Thank you so much for the grant that allowed us to have this program. So I'm your host, and I'm here with TexasDirector.org. I also have a podcast called Childcare Conversations where we talk about a lot of these topics.
I want to introduce Ryan Melendez. So Ryan and I are going to be presenting together. Ryan is the vice president at Truist in Austin. My name is Holly McGowan. I'm a mentor with SCORE Dallas. I'm also in charge of the workshop program with the SCORE Dallas chapter. So this session is all about securing the capital that you need, but we're going to start at a very basic level to make sure that everybody is on the same page. If you are opening a business or you are running a business, you are a person who organizes and operates a business taking on greater than normal financial risk. That's important to understand because at some point or another, most successful business owners are going to have to borrow some money. And we'll go through all of that. You'll understand it. But borrowing money means taking risk. It also means that you have to spend money to make money. Now, you know that if you're interested in opening a childcare business and you haven't done it yet, you know that you're going to have expenses and that you're going to be taking risk. And if you have opened a childcare business, then you know that you're going to have to spend more money and that you're already taking a bunch of risk. But this business is not to get into if you can't handle taking greater than normal financial risk. And at some point or another, that probably means securing some additional capital for your business from someone else besides you. So let's talk about ways in which you can bring money into your business. A loan is you borrow it and you pay it back, usually with interest. There are some loans that don't have any interest. They are called loving mom and dad. Or loving family member, or maybe you're borrowing from your own savings. But most loans you borrow and you pay back with interest. It is possible to get a grant. However, I want to be very clear, there are no grants for startups. It just is. I'm really sorry. This is always the worst part about being a SCORE mentor, is telling people this. But there are no grants to start up a business, even if it helps society, like a childcare business. Once you are in business, if you are a nonprofit childcare, which some are, it is possible to get grants. However, they're very difficult to get, and most businesses do not get them. You can earn money in your business, right, by selling more tuition and services, or you could raise your price, or you could sell add-ons, transportation services, whatever. And then, of course, the last way is you can sell the business by adding or changing owners. So if you have good records and you have a business that is, doing well, and you can prove that it is producing results, then you could maybe add a partner and they would put some money in, or you could possibly sell the business and receive some cash for that. So these are really the ways to get money. We are going to talk about the world of loans, because that is the reality of how most business capital is acquired. Okay. Not every loan comes from a bank, although many do. A bank is a for-profit institution. A credit union is very similar, but it is a non-profit institution. The difference between a bank and a credit union is that a bank is in business to serve its owners, right? And a credit union is in business to serve its customers. However, it's not that simple, because banks tend to offer more services and more convenience. Credit unions, because they are nonprofits, tend to be a little bit more limited. Every circumstance is different, but it is often better to go to a bank because a bank has more branches and more services. However, sometimes a credit union can be a better option. There's also something out there called a Community Development Fund Institution, a CDFI, and you might have heard of something like that. People Fund, Lift Fund, those types of organizations. They are nonprofits that grant loans backed by the government. Now, it's an interesting time for that because the government is in the business, the federal government is in the business of shrinking right now. There are also non-bank lenders, or we call them trades. A non-bank lender is somebody who might loan you money for a specific thing. So let's say, for example, that you purchase a bus, right? You would go to a dealership and buy a bus, and the dealer might offer you financing, right? They would be a non-bank lender. There are other situations where you have vendors who might offer credit in order to purchase their services. That would be a non-bank lender. The last is the SBA, but it turns out you cannot borrow money from the SBA. What? So let's talk about that so that everybody's on the same page about what the Small Business Administration is all about. So a lot of people think that you call up the SBA to get a loan, but that is not what happens. The SBA has a different job. Now, there are a few circumstances where the SBA does loan money, but we're not going to get into those here because they don't really apply here. So let's talk about what the SBA does do. A very simplified version of this is that you go to a lender to apply for a loan. And let's say that the lender looks at it and says, you know, I don't think our bank is going to approve this loan. It's just too risky. So the lender contacts the SBA, the Small Business Administration, and they agree to back part of the risk. So they will usually back somewhere around 75% of the risk. So basically what the SBA says to the lender is, hey, if your client does not pay back their loan, we will reimburse you. Now, it's a painful process and the lender doesn't want that to happen, but it's often enough for the lender to be able to say, okay, I will offer a loan, right? So the lender makes the loan, not the SBA. These loans are meant for people who cannot get financing any other way. Businesses that have kind of exhausted all of their other efforts, I will say that SBA loans in general are not for startups. They are for businesses that are already ongoing. So let's talk about that. This is an image from the Small Business Administration, and I think it really helps explain, if you're looking for money, where you're going to get it. If you are starting your business or you're in the early stage of your business, your money is probably going to have to come from personal savings or family and friends. A lender needs to see a track record before they're going to loan to you. So a bank and a credit union are only going to consider a loan if you are maturing and established. But I want to be clear, if you are starting a business and you are thinking to yourself, I can't start this business without some more money, these are the places you're going to need to go. A lender is only going to loan you money if they believe that you can pay that money back timely. And the only way they know that is if you have records from an existing business. A lot of people think that a lender will loan money because you deserve it, but it doesn't work that way. And Ryan is going to explain more of that as we get into this. I want to talk a little bit about risk and credit, and I'm going to turn it over to Ryan.
Good afternoon, everybody. Ryan Melendez here from Truist Bank. Thank you, and we're really happy to be here with you guys. Honestly, my job every single day is evaluating risk. Besides to be a loan officer, I am risk evaluator. Ali mentioned a lot about it's not what you deserve, it's what you need. As a banker, the last thing I want to do is give you a loan you cannot pay. In the small business lending, everything starts with the business owner. And I think it's important to understand that if you're in the startup process, patient plays a vital role in your business, okay? So don't get discouraged. So yeah, risk is definitely expensive. Rates are directly correlated with your risk position. And so how do we evaluate risk when we're talking about interest rates? The better your credit, And not only in this particular case, we're talking about small business, not only you as a personal guarantee, right? That sometimes we forget about the business, and the business also generate credit. So the credit is the base for us as a loan officers to evaluate the risk. This is very interesting. Holly mentioned that very well. It's true, when you involve the small business administration, the loans can be more expensive. This is not a subsidized loan. It's a backup loan. And that's something you got to understand. So I have some clients that come to me with an SBA loan. They have higher interest rate. How high? 12, 13% sometimes. So they're also asking for fees you have to pay even up front or at the end of the loan. And that's something that you have to take in consideration when you asking the government to cover you or back your loan or line request. So how do you make reducing the risk? Creating a relationship or banking relationship is crucial to understand that, because it's our job as a bankers to really and understand what are you trying to do in order to situate your loan request in the right solution. So having our banking relationship absolutely reduce the risk. This is super crucial, guys. You must track your transactions. Absolutely. You should have a QuickBooks, Gusto, Wave. There's a lot of options in terms of software you can keep records. You have to be able to prove that you're generating any type of revenue. And that's one of the things that sometimes I encounter when I got a small business request. Having a good track system that can prove those things are crucial. Well, I can give you a legal definition of personal guarantee, which is a note that we adding into your closing package when you sign the loan, saying, hey, if your business cannot pay this obligation, I'm gonna go after you. Basically, I'm gonna transfer this debt from your business to you, and you're personal responsible for that. When you are getting a loan, you're signing a legal binding contract. So when you sign your closing documents for your home, for your vehicle, for your credit card, you're signing a contract with that financial institution. And it's in this particular case, in terms of small business lending, when you sign your paperwork, even though you can be LLC, you think you're not liable, you allow with this contract, allow the banks or financial institutions to go, just put it this way, be straight with you guys. If you cannot pay your own obligations, you're behind your credit card, you're behind your mortgage, you're behind on this, you're behind on that, then how are you going to be able to pay the small business loan? So let's talk about the 5 C's of credit, which is have to do a lot with personal guarantee. Okay. So basically in banking, we use this principle to determine how strong is your personal guarantee. So character, right, is basically your credit report. Typically in a small business, the credit report that we're looking at is for the last 5 to 10 years. That determines your character, right? Then we have the capacity. Do you have enough cash reserve and your income? So capacity has to do with income and cash reserves, okay? Very important. And that income will determine if you will be able to repay the loan or not. Capital means savings. So you have enough money to pay your bills, to pay other people, and to pay yourself, and also to reinvest in the business. That's why I always recommend my small business clients to always have a saving business account. It's very important, that we call capital formation account. Collateral. Do you have anything to offer to lower our risk? So maybe you have a location and you want to put that location as a collateral. You have equipment do you want to put as a collateral, right? Now, very important to mention, every financial institution, bank, or credit union had different take on collateral. The collateral that I ask maybe differ from a collateral that maybe other bank or credit union is asking you, or to be acceptable for a financial institution, okay? Then conditions have to be, what's the purpose of this money? And once again, as a banker, we have a moral responsibility. The last thing we want to do is give you money you cannot pay. So basically, that's a 5C of credit. And believe me, guys, understanding this is all the way into the commercial banking side. Okay. When you interview the banker that's going to help you with your loan, which you should do that, this is one of the questions you're going to ask to the banker. Hey, what is the range in this bank you use to determine credit score for small businesses? In my case, it's 670 and higher. The higher the score, you have more chances to get approved, to be honest. And the rate will be better, the terms will be better. So normally 670 credit score. Generate business credit is not that complicated. It's basically understanding how the process works. So if I want to give you a quick example. If you want to generate business credit quickly, you can put your cell phone under the business. So the carrier, the wireless carrier, can report that into the business credit. That's one of the ways. One of the companies I recommend the most is Dun & Bradstreet. No commercials noted on that. Dun & Bradstreet is basically on the business side. You can contact them to the website, and you can register your business to Dun & Bradstreet, and they can give you a DUNS, which is stand for Digital Universal Number, and then they start recording that activity in your credit, business credit. With the trades, what you can do is ask for a letter of credit from your trade. When I say trades, can be people that supply you with stuff and you pay. So they can give you a letter of credit. You can send it to Dun & Bradstreet, yet they can record that information into your business credit. One of the things you can do is basically check your credit regularly. The easiest way to check your credit is going to annualcreditreport.com, which is an official site where the three main bureaus report credit. Now, the only thing on this one, they only give you the report. They don't give you the score. So to obtain the score for that particular report, you have to pay a fee of $10, I believe is the fee. If you don't understand your credit report, I recommend that you go to your banker and say, hey, what do you think about this? Things can go wrong at any time, but if you have a plan, you understand credit, you're going to be just fine. You and your business will be fine. Terms loans are for a specific purpose. So you borrow for a specific purpose. Then I give you a sum of money, some term, 5 years, 10 years. You use the money to pay for whatever you need, and you start paying me back. As soon as you paid off that term loan, that's it. You don't have no more access to capital. So in the line of credit is for something that's recurring. So you have to look at the line of credit like a huge credit card with the less interest rate. That's the main difference between the term loan and the line of credit. There's a lot of things that people use to finance your business. Some people pull home equity line of credits. They have an equity in the house. Sometimes they use that, but definitely start with you.
One of the things that a lender is going to look for is they're going to look for some financial reports. So basically what you do is when you start tracking your transactions, every time you get a payment, every time you pay for something, right, you're tracking those transactions. After a while, you can take that data and use that to create reports. The most common reports that a lender is going to look for is an income statement that shows whether your business is profitable. They're going to look for a balance sheet that shows what a business owns and who owes it money. And they're going to look for a cash flow statement that shows how you're receiving and spending money. If you're looking at this and thinking to yourself, I don't really know what those are, Google is your friend. You can learn a lot, but you can only generate these reports, right, if you are using your transaction records to create them. You can't just make them up, or you can't just project it, right? These are actually reports that you generate using the data that you have collected by logging your transactions. One thing I want to cover quickly is that there's a lot of people who overpay for help. You can keep your books if you have a background and you understand that, and you can save some money by doing it. However, if you need help, a bookkeeper is a good option. Now, a bookkeeper is just a person who is not going to, really sit down and talk strategy with you. They're just going to help you keep records of your transactions and run some basic reports for you. But in a lot of cases, that's all you need. If you need more, if you need to sit down and talk to somebody about strategy, that's when you might want to go to an accountant or possibly even a CPA. A CPA is a certified professional accountant. They've taken a test. They've gone through a lot of education. They cost more. Now, the question is, okay, what do I do if I don't have transactions? Right? If you're new or you haven't been tracking your money properly. So it is possible to create some projections when you're applying for a loan, but I will tell you that you really need to carefully research those. You can't just say, I think that I am billing $150 a day. I don't know, whatever, I'm making up something, right? You really need to be able to say, here's where I got these numbers. These are really good resources to help you get set up if you are not tracking your expenses and your transactions.